My name is Eric McCardle, Managing Director of Advisor Solutions here at Simplify and author of our latest Fund Insights blog post, Diversifying Equity Income Portfolios with VIX Carry, featuring the Simplify Volatility Premium ETF, SVOL. In this blog post and recap video, we're going to discuss why SVOL should be considered equity income, how it compares against other similar strategies, and how it can potentially add better risk-adjusted returns and diversification benefits to your equity income portfolio. First, let's define what equity income is and what has made it so popular for investors. Equity income is a strategy that has a capital appreciation or beta component to the market while also having an income component that can provide cash flow or dividends to the end investor. And again, over the years, this has become really popular, especially for retirees and folks looking to provide diversification benefits to broader portfolio configuration. So where does SVOL fit into the equity income universe, and how is the portfolio managed? Well, to begin, we'll start by unpacking what we do in the strategy. And really what that consists of is shorting VIX futures contracts at one point of the curve and then letting the contract roll down as it moves closer to expiry. This happens the vast majority of the time as the term structure of VIX tends to be in contango or is upward sloping. That's what we would consider the income component of SVOL. On the other hand, the beta component of SVOL is really derived from the level of VIX or the level of the VIX term structure. And that as the VIX level drops, we would expect SVOL to appreciate, whereas if the VIX level were to rise, we would expect SVOL to lose value. When we compare those total returns to the S&P 500 over time, we find that all of the strategies assessed have a positive beta to the S&P, and that SVOL on any given month is going to have a beta of between 0.5 and about 0.7. But let's take it a little bit deeper. We look at the data for all of the strategies, including SVOL, since SVOL's inception date in May of 2021, we find that SVOL had not only a lower max drawdown during the assessed period, but also an attractive Sharpe ratio as reflected by the total return of the fund and the low volatility nature of the return stream. But how does SVOL compare against other equity income strategies in terms of diversification benefits in a broader equity income portfolio? Well, when we look at the matrix of the different profiles that we assessed, we find that SVOL has a positive correlation to the other equity income strategies, but also has a low enough correlation to where you could see diversification benefits by including it in an equity ensemble portfolio. So a few takeaways from the blog. 1, we established that SVOL is an equity income strategy. 2, we found that it can provide attractive risk-adjusted returns relative to other equity income offerings. And 3, we find that it does provide diversification benefits relative to other equity income strategies and can be used in an equity ensemble approach. Thank you for tuning in. Thank you for reading the blog. We appreciate your feedback. We'll talk to you next time.